2024, Nvidia became the most valuable company in the world, overtaking tech giants Apple, Microsoft, and Google. Their GPUs power every major AI breakthrough. But what if I told you that the entire AI economy might be built on a house of cards? This is the story of how one company may have engineered the greatest financial flywheel in modern tech history, and why it all might come crashing down. To understand how we got here, we need to go back to November 2022. OpenAI releases ChatGPT to the public. Within 5 days, it has 1 million users. Within 2 months, 100 million. It becomes the fastest growing consumer application in history. Suddenly, every company on Earth realizes that they need AI, and the need is growing exponentially. McKinsey estimates that generative AI could add between $2.6 to $4.4 trillion annually to the global economy. That's more than the GDP of the entire United Kingdom. They claim that we are sitting at the edge of the greatest economic transformation since the Industrial Revolution. In healthcare alone, AI could save the industry $150 billion annually by 2026 through early disease detection and personalized treatment plans. In agriculture, AI-powered farming is increasing crop yields by 30% while cutting water usage in half. In Austin, Texas, AI tutors are helping students score in the top 1% of standardized tests with only 2 hours of study. But as amazing as all of this sounds, there's a critical bottleneck for AI: computational power. Any good model will use massive amounts of it. And for that, you need GPUs, graphics processing units. The same chips that were once used primarily for video games are now powering the AI revolution. And one company controls almost all of them. Nvidia was founded in 1993 and ironically replaced Enron for a spot in the S&P 500 in 2001. They started off as a graphics card company for gamers, but now Nvidia commands between 80 to 95% of the AI chip market. Their H100 GPU, launched in 2022, costs around $30,000 per unit. Every AI startup is snapping them up. Sam Altman, CEO of OpenAI, recently stressed, "We're desperate for more GPUs. It's the thing that's constraining us the most." But this desperation has created something unprecedented in the history of technology. A market where one company doesn't just dominate, it essentially is the market. And that company has figured out how to turn this dominance into a perpetual money machine. But to understand Nvidia's stranglehold, you first have to understand CUDA, which stands for Compute Unified Device Architecture, and is Nvidia's proprietary programming platform. Launched in 2006, CUDA allows developers to use Nvidia GPUs for general-purpose processing. Think of it like this. Imagine if Microsoft had not only made Windows but also owned the only programming language that could create software for Windows. And imagine that that language took developers years to master. That's CUDA. Over the past 15 years, Nvidia has methodically built an ecosystem. They funded university programs, created certification courses, and built a community of millions of developers who only know how to program for Nvidia hardware. Nvidia's real moat isn't the hardware, it's the software. It would take a competitor not just years, but potentially a decade to build a comparable ecosystem. AMD has tried with ROCm. Intel has tried with OneAPI. Google has built its own TPUs. But when a startup raises $100 million to build an AI model, they don't experiment. They buy Nvidia, because that's what everyone else already uses. That's what all the pre-trained models are optimized for, and that's what their engineers know. It's a classic network effect, but on steroids. And this is where the company can cash in. Despite explosive demand, Nvidia has maintained what many industry insiders call artificial scarcity. They could dramatically increase production, but they don't. Why? Because it is in their interest to drip feed the supply into the market. Nvidia doesn't actually manufacture its own chips. They rely on one firm, Taiwan Semiconductor Manufacturing Company. The fabricator has insistently offered to dramatically increase production capacity for Nvidia. In fact, industry sources suggest that they could double or even triple output within 18 to 24 months. This shortage is intentional. When you have customers willing to pay any price, why would you flood the market? The result is a product that costs $3,300 to produce, but can be sold at market for $30,000. That's almost a 1,000% markup. Such a supply constraint has created a secondary market where H100s trade like commodities. Some companies are paying 50% premiums to skip the line. Others are signing multi-year contracts at inflated prices just to guarantee supply. Lambda Labs, a cloud compute provider, recently admitted, "We're buying GPUs from wherever we can find them. The official channels have 2-year wait times." We've seen this before. During the crypto boom of 2017 and 2021, GPU shortages drove prices through the roof. Miners were paying double or triple MSRP. But when crypto crashed, so did GPU demand. Nvidia stock fell 50% in 2018 when the crypto mining industry collapsed. But this time, Nvidia says that it's different and that the demand is sustainable. Jensen Huang, CEO of Nvidia, claims that it's not speculation. But is it? Well, here's where our story takes a turn into the surreal. Because what's happening in the AI industry right now isn't just a gold rush. It's a carefully orchestrated financial loop that would make even the most creative Wall Street engineers jealous. Let me walk you through exactly how it works. Step 1. The cloud giants buy GPUs. As we know, big tech has insatiable demand for compute power. Microsoft, Amazon, Google, and Meta have committed over $213 billion combined to AI infrastructure spending in 2024 alone. The majority of this goes to Nvidia GPUs. Microsoft has reportedly ordered more than 150,000 H100 GPUs. At $30,000 each, that's $4.5 billion just for one product line. But Microsoft doesn't pay all in cash. They often pay partially in Azure credits. Now comes step 2. Nvidia buys back its own stock. The company takes the money it earns from GPU sales and uses it to pump up its own stock. In 2024, Nvidia announced a $25 billion share buyback program. This is on top of the $15 billion they bought back in 2023. Nvidia's stock price has increased 1,300% since 2019. In mid-2024, it overtook Apple in terms of market cap and is now the most valuable company in the world. In fact, it has a total market capitalization of $4.4 trillion as of early December 2025. Step 3. VCs raise AI mega funds. Seeing Nvidia's success, venture capitalists have raised unprecedented amounts for AI investments. Andreessen Horowitz raised $7.2 billion. General Catalyst raised $8 billion. In total, over $100 billion in venture funding was earmarked for AI startups in 2024. But where does this money go? Right into the hands of the AI startups. Step 4. Startups burn cash on compute. Anthropic, creator of Claude, has raised $7 billion. Their primary expense? GPU compute. They publicly stated that they'll spend over $1 billion on compute in 2024, and private analysis has estimated it at $2.6 billion. Character AI raised $150 million. They immediately signed a $100 million compute contract. Inflection AI raised $1.3 billion. Their CEO admitted that most of it goes to compute costs. Step 5. Cloud credits create artificial demand. Now here's where it gets really interesting. Microsoft, Google, and Amazon don't just sell cloud compute, they also invest in AI startups. And when they invest, they often provide cloud credits as part of the deal. Microsoft invested $13 billion in OpenAI, but much of that investment comes in the form of Azure credits. OpenAI then uses those credits to train models on Microsoft's Nvidia GPUs. Microsoft then reports this as revenue. It's like a restaurant investing in a food delivery company by giving them gift cards to their own restaurant, and then counting the gift card redemptions as sales. Now comes step 6, Nvidia investing in its own customers. Nvidia's venture capital arm, N-Ventures, has quietly invested in dozens of AI startups. Cohere, Inflection, Hugging Face, the list goes on. These companies then use that money to buy Nvidia GPUs. This is what is more commonly known as vendor financing. These GPU sales are recorded as revenue, boosting Nvidia's top-line growth and padding their profit margins. The investments can be tax write-offs if the companies fail. Now, the feedback loop is complete. For clarity's sake, let's make this crystal clear. First, Nvidia sells GPUs to cloud providers. Then, those cloud providers invest in AI startups with credits. Third, those startups use those credits to rent GPUs from the cloud providers. Fourth, the cloud providers buy more GPUs from Nvidia. 5, Nvidia invests that money into AI startups. And 6, those startups buy more GPUs. Finally, 7, the cycle continues. This is where the viral circular financing meme comes from. It's a financial flywheel effect where the same couple $100 billion is rotating between tech giants, Nvidia, and AI startups. And everybody is counting it as revenue. Now you might be thinking that none of this matters. As long as these AI companies are creating value and driving growth, who really cares how they're funded, right? But they're not. Let's look at the unit economics. OpenAI, the most successful AI company, reportedly loses money on every ChatGPT Plus subscription. At $20 per month, they're losing an estimated $5 to $10 per user due to compute costs. Even Sam Altman has admitted that they are losing money on its Pro subscription plan because people use it much more than they had expected. Anthropic's Claude, Google's Bard, Meta's Llama, none of them are profitable. In fact, industry analysis suggests that for every dollar of revenue generated by the large language models, companies are spending $2 to $3 on compute. Compare this to traditional software. Salesforce has 70% gross margins. Adobe has 88%. These AI companies, negative margins. But it doesn't matter. Investors keep plowing more and more money in. Big tech is now spending more than $60 billion a quarter, rivaling the dot-com and shale oil booms. And every bubble needs enablers, people who benefit from inflating it. And the AI bubble has plenty. Let's start with the sell-side analysts. Of the 50 analysts covering Nvidia, 49 have it as a buy or strong buy. The lone holdout has it as a hold. There's not a single sell rating. The same analyst predicted Nvidia would earn $20 billion in data center revenue in 2023. They earned $47 billion. For 2024, they predicted $60 billion. Nvidia's guidance suggests it'll be over 100. But the thing about Wall Street analysts is that they're not really in the business of being right. They're in the business of generating trading commissions. And nothing generates commissions like volatility and hype. Then there's the media. Every AI announcement, no matter how trivial, gets breathless coverage. Bombastic claims like AI will change everything or that it's the fourth industrial revolution are touted on TV. One study found that positive AI coverage outweighs negative coverage by a ratio of 8 to 1. During the dot-com bubble, that ratio was 5 to 1. The conference circuit itself has exploded. There are now over 500 AI conferences annually, up from 50 in 2019. Tickets cost thousands. And who's the primary sponsor at nearly every event? Nvidia. Even academia has been captured. Nvidia has donated over $500 million to universities for AI research. They've created 3,000 teaching labs. They've certified 400,000 students. These students graduate knowing only one thing. Nvidia is AI, and AI is Nvidia. Self-custody is key, and the Blockstream Jade Plus hardware device makes it simple and secure. Store your Bitcoin easily with a setup that takes only minutes. Pair it with the Blockstream Green app on mobile or desktop to use advanced features like multi-sig, air-gapped J-Link, and secure QR code transactions. Take control of your Bitcoin today. Get the Blockstream Jade Plus using the link below and use code PB10 for 10% off to support this channel. If this story sounds familiar, it's because we've been here before. Many times, in fact. In the late 1990s, it was the internet. Cisco, the company that made the routers, the picks and shovels of the internet, saw its market cap hit $500 billion. Revenue was real, growth was real, but the sky-high valuations were fantasy. Cisco later lost 90% of its value. 25 years later, it still hasn't recovered. But perhaps the best analogy is the railroad bubble of the 1840s. Like AI today, railroads were genuinely transformative. They would reshape commerce, enable new industries, and change society. All true. But that didn't mean that the railroad stocks were good investments. Between 1844 and 1846, British railway shares rose 300%. By 1850, they'd lost 85% of their value. The railroads were built. They had transformed the economy, but the investors who funded them, most lost everything. The pundits say it's different this time. But cracks are appearing. Insiders have now sold a massive $1 billion of Nvidia stock. Nvidia's own CFO recently sold $10 million in stock in a single month. And Jensen Huang, the CEO, sold over $20 million over the course of 1 week in June, according to SEC filings. And behind the hype and the headlines, there's a sobering reality that most people do not see. The vast majority of AI implementations are failing. According to a RAND Corporation study, 80% of AI projects fail to move beyond the pilot phase. Of those that do deploy, less than half generate positive ROI within 2 years. MIT's findings are even worse. One report noted a 95% failure rate for generative AI pilots at firms across the US. Remember IBM Watson, the AI tool that was supposed to revolutionize healthcare? IBM spent $15 billion developing it over a decade. They sold it for parts in 2022. MD Anderson Cancer Research Center spent $62 million trying to implement Watson. They canceled the project with nothing to show for it. Even McDonald's spent millions on AI-powered drive-thrus. They shut it down after it kept adding bacon to ice cream orders. Zillow's AI home buying algorithm lost $500 million in 3 months. And Amazon quietly shut down their AI recruiting tool after it showed bias against women. Dr. Gary Marcus, AI researcher and professor emeritus at NYU, has been warning about this for years. We're at the peak of inflated expectations. The technology is impressive but limited. We're trying to use sledgehammers to perform surgery, he said. The problem isn't that AI doesn't work. Is that it only works for very specific, narrow, and defined use cases. But the market is pricing in artificial general intelligence, a new industrial revolution, the singularity. A survey of 500 Fortune 500 companies by BCG found that while 90% are experimenting with AI, only 10% have achieved significant financial impact. The rest? They're burning money on experiments that never pay off. Every bubble ends the same. Gradually and then suddenly. We're now in the gradually phase. The signs are everywhere if you know where to look. Stability AI, once valued at $1 billion, is struggling to pay its bills. Jasper AI, valued at $1.5 billion, has laid off staff and is burning through cash. Even major players like Google and Microsoft are quietly shutting down AI projects that can't find product market fit. Similar startups are dropping like flies. TechCrunch analysis showed that 966 startups failed in 2024, a 25% increase from the year before. And venture capitalists are getting nervous. Sequoia's David Kahn recently published a piece called AI's $600 billion question, pointing out that the industry needs to generate $600 billion annually in revenue to justify current valuations. Actual revenue is less than $75 billion. The IPO window is shut. Not a single pure-play AI company has gone public successfully in 2024. The last one that tried, Databricks, pulled their IPO after investors balked at the valuation. The public markets want profits, not promises. Even more telling, enterprise buyers are pulling back. A survey by Forrester found that 65% of CIOs plan to reduce AI spending in 2025. Not because they don't believe in AI, but because they haven't seen returns on their 2023 and 2024 investments. Even traditional SaaS companies have expressed their doubts. The Salesforce CEO recently called AI a commodity feature and stressed that it couldn't replace general tech. The parallels to previous bubbles are uncanny. In 1999, Cisco's CEO John Chambers said, "We're in the midst of the second industrial revolution." The stock peaked 3 months later. In 2021, Cathie Wood said crypto would change everything. Bitcoin peaked the next week. Now we have Sam Altman saying AGI is a few years away. Mark Andreessen claiming AI will save the world. Jensen Huang declaring that we're in a new industrial revolution. History doesn't repeat, but it rhymes. The smart money is already moving. Sovereign wealth funds have reduced AI allocations by 20%. Pension funds are rotating out of tech, especially in the UK. Even SoftBank, the patron saint of bubble investments, is pulling back. The AI revolution is real. The technology is transformative. The potential is enormous. But profit and potential are two completely different things. The internet was transformative too, but most internet companies from 2000 no longer exist. Nvidia has built something remarkable. They've created a circular machine where money flows from investors to startups to cloud providers and back to Nvidia. It's brilliant. It's lucrative. But is it sustainable? The answer lies not in the technology, but in a simple question. Can AI companies generate real revenue from real customers solving real problems? Not revenue from other AI companies, not from venture capital, but real revenue. The clock is ticking. Competition is quickly emerging, and the easy money is already gone. Is Nvidia the architect of the greatest financial flywheel ever created? Or are they simply the best positioned company in the final stages of the biggest bubble since the dot-com era? The answer will define the next decade of technology, of finance, of human progress. The AI bubble isn't just about Nvidia, it's about us, our hopes and our dreams, our tendency to confuse innovation with investment returns. In the end, the market will decide. It always does. The only question is, will you be on the right side if the bubble pops?
As a central bank, we have the ability to create money.
We've had an 8-day losing streak in the Dow.
Inflation is our friend.
It's a tough problem. The question is, how long will this go on?